Hi all, Chris Rae from SEQ Advice. Last week I caught up with Hik Chadirchi from Ausbil Investments, given the week it has been with the US elections. Hik has been keeping us up to date during COVID-19, which has been informative and reassuring for us all. Here's what Hik had to say.
Thanks, Chris, and it's good to be with you guys again. First of all, I'd like to, yes, it would appear if you look at where share markets are right now that they haven't fully absorbed the effects of COVID-19. I would say there is still risk. We're seeing a second wave, quite an aggressive second wave in Europe, and the United States has had over 100,000 infections in one day. So COVID is still there. And there is, of course, risk that things don't track as well as one would hope. But there is optimism around the vaccine, a number of vaccines, and that's why equity markets have been quite buoyant. Of course, there's also the little issue of a US election at the moment, so it does seem equity markets are very resilient given all of that. To your question, though, about what's the focus for continued growth in equities, it's going to be economic recovery, and in particular the pace of that economic recovery and which parts of the stock market will benefit from that recovery. So we've seen this year really strong performance from certain stocks and certain sectors, but not all stocks or sectors. And there are some sectors you might say have over-earned due to COVID, so there may be a movement between different companies and different sectors, and that will be the impetus for the market to potentially go higher. It's if those stocks that have been and sectors that have been left behind start to perform better. I mean, you can certainly argue that some of the best performing stocks have done so because they've over-earned, i.e. they've benefited from the changed spending patterns, but there are other stocks that I believe have performed well because trends that are already in place have just been accelerated by COVID. But there certainly are sectors where they've done poorly because of COVID. And if we see an economic recovery and an opening up in 2021, those stocks should do better. And that's what will probably drive markets on from here.
That's great. So just going on to a little bit of a different topic. Now that retirees are basically earning nothing on their term deposit rates, are the new all-time low bank interest rates now going to push more focus to possibly property and shares and other types of assets?
Yes, undoubtedly. I mean, there will have to be a focus on more risky assets because retirees and other investors won't be able to generate a reasonable amount of income from cash and term deposits. I mean, that's already been the case, but it's only been further exacerbated by what the RBA did on Tuesday. This is the problem now. Where do you generate income? You get better income from property and shares, certainly, than you get from cash and term deposits. Of course, properties and shares are volatile. Shares are more volatile than property, but of course, property doesn't have the liquidity, the easy access of your capital that shares do. But when you're investing, you always have to take into account risk versus return, and there is undoubtedly more risk, but a better income now from property and shares. One thing I would point out is that the real problem is the RBA has flagged that interest rates are going to remain low at these historical low levels for at least 3 years. So if it was a more temporary emergency low level of interest rates, maybe you could stay in cash and term deposits. But this is not going away anytime soon, these ultra low rates. And so investors, even if they're risk averse, have to look elsewhere for income. So, I mean, we personally feel that low rates, though, the positive part about low rates is they will help improve the economy and support both shares and property as part of that recovery. And so, maybe now isn't such a bad time to be looking at property and shares for income, because we feel that they're somewhat supported by the low interest rates and therefore perhaps less risk.
Yeah, there's some important points there you've brought up, and we're living in different times to what we're used to. So it's certainly many things to think about for investors. Well, that's great, Hik. Many thanks again for your valuable time and taking the time out of your busy schedule. All the best, and we'll catch up soon for another chat to help our clients out in the future.
No problem at all, Chris. Thanks for having me.
Thanks, Hik.
Cheers.